Hi everyone! Today we're talking about disability insurance. What happens if an illness or injury stops you from working? That's where disability insurance can help protect your income. We'll explore short-term and long-term coverage, claim approvals, eligibility rules, and SSDI benefits. Many people don't know why claims get denied or how to improve their chances of approval. Understanding policy terms, exclusions, and waiting periods is extremely important. By the end of this video, you'll know how disability insurance works and how to choose the right coverage for your needs. Let's get started.
Okay, let me ask you a serious question. What actually happens if your paycheck suddenly stops tomorrow? Like if an unexpected illness or a sudden injury completely prevented you from working, how long would your savings really last? For most of us, that's a deeply uncomfortable thought, right? But it's exactly why we need to talk about income protection today. Welcome back to The Explainer. Today, we're going to demystify the complex and, let's be honest, often overwhelming world of disability insurance. Think of this as your personal survival guide to protecting your absolute greatest financial asset, your ability to earn a living. So, here's our roadmap. We're going to cover the basics of income protection, decode those tricky disability definitions, navigate the fine print, compare private versus government coverage, and wrap up with taxes and filing claims. All right, let's jump right into Section 1, the basics of income protection. Okay, let's break this down. At its core, disability insurance is really just income replacement. It's protection that steps in to replace a portion of your paycheck if an illness or injury stops you from doing your job. And why does this matter so much? Because statistically speaking, about 1 in 4 American workers will become disabled at some point in their careers. It's not just a remote possibility. It's an absolutely essential financial safety net. Now, you've got two main types of coverage here. Short-term disability is for those temporary issues. Think recovering from a surgery, something like that. It typically pays a higher percentage of your income, around up to 80%, kicks in pretty quickly, and lasts anywhere from a few months to a year. Long-term disability, on the flip side, is for severe, extended absences. It usually replaces a slightly lower percentage, around 60%, and has a longer wait time, but it can protect you for years or even decades, all the way up to retirement age. Moving right along to Section 2, decoding disability definitions. Listen closely, because this is arguably the most critical component of your entire policy. Own occupation is the absolute gold standard of coverage. Under this definition, you are considered disabled if you cannot perform the duties of your specific profession. So, for example, if a highly specialized surgeon develops a hand tremor, they obviously can no longer operate, right? Well, under an own occupation policy, they still receive their full benefits, even if they decide to go get a job teaching at a medical school instead. Now contrast that with the any occupation definition. This is a crucial distinction because it's far more restrictive. Here, you're considered disabled only if you cannot perform any job that fits your education or training. If that same surgeon with a hand tremor had an any occupation policy, the insurance company might just deny their claim entirely, basically saying, well, your hands shake, but you can still teach or consult, so go do that. You'll probably also see a few other variations in the fine print. You've got modified or transitional own occupation policies, which are essentially hybrids that might offset your benefits if you take a new job. There's partial or residual disability, which kicks in if you can only work part-time and suffer an income loss. And then there's presumptive disability, which automatically pays out for catastrophic losses, like losing your sight or the use of your limbs. Honestly, understanding your policy's specific definition dictates entirely whether your future claim gets a green light or a red light. Which brings us to Section 3, navigating the fine print. Even with the perfect definition, there are tricky rules to watch out for. Take your elimination period. That's basically your waiting time before you actually get paid. It drastically affects your wallet. If you want a really short 30-day wait, you're looking at a premium of nearly $1,667 a month. But if you extend that wait to 90 days, your premium drops by almost half to $843. Basically, the longer you can afford to wait using your own savings, the cheaper your insurance is going to be. You also really have to watch out for policy exclusions. Pretty much all policies exclude pre-existing conditions if they fall within a certain look-back window. But the huge red flag you need to note is the strict cap on mental or nervous conditions. Most policies limit their payouts for conditions like severe anxiety, depression, or substance abuse to a strict 2-year maximum, and that's even if the condition leaves you permanently disabled. All right, on to Section 4, private versus government coverage. A lot of folks think, hey, I'm covered through work, I'm totally safe, but relying solely on group coverage from your employer can actually leave you pretty exposed.
The carrier can change the rules every single year. It usually only covers your base salary, meaning bonuses and commissions just vanish, and it's very often reduced by any Social Security benefits you might receive. A privately owned individual policy, however, guarantees your rates up to age 65, covers your total compensation, and doesn't get offset by other programs.
Now, you might be thinking, well, won't the government just take care of me through Social Security? Well, Social Security Disability Insurance, or SSDI, is incredibly strict. It only pays for total disability. The government explicitly assumes you've got other resources like personal savings or short-term insurance to get you through anything less than a catastrophic, completely long-term event. To give you an idea of just how tough it is to qualify, let's walk through the Social Security Administration's rigorous 5-step eligibility gauntlet. First, they check your income. Second, they evaluate if your condition significantly limits basic work activities. Third, they check if your condition is on a highly specific medical list. Fourth, they determine if you can do your past work. And finally, step 5, they look at your age, education, and skills to see if you can do literally any other type of work in the entire national economy. It is a very, very steep hill to climb. Let's actually jump back to step 1 of that test for a second, because this number is absolutely crucial. By the year 2026, if you are working and earning more than $1,690 a month, the SSA considers that substantial gainful activity. If you make a single dollar over that amount, they generally will not even consider you disabled. End of story.
And finally, we've reached section 5, taxes and filing claims.
So, here's a critical question you need to ask yourself right now. Are your disability benefits taxable? Because understanding this ultimately determines exactly how much actual cash hits your bank account when you are at your most vulnerable.
Here's the IRS golden rule on disability taxes, and it's a real game changer. If your employer pays your insurance premiums, which is super common with group plans, or if you pay them with pre-tax dollars, the IRS will tax your disability benefits as regular income. But if you pay your own premiums with after-tax dollars right out of your own pocket, your benefits are completely tax-free. When you're trying to live on just 60% of your old income, keeping it tax-free is a massive advantage.
Let's talk about actually getting it done. Filing a claim can be totally daunting, but here's how the first half of the process works. Step 1. Always contact your agent or advisor first. They know all the pitfalls to avoid. Then, review your policy, notify your employer, and meticulously gather every single piece of medical documentation and employment record you have. Only after you've done all that should you complete and submit the claim form. Take your time, do not rush this, and make a silly mistake.
And here is part 2. Once you've submitted everything, you've got to follow up continuously. Respond to any additional requests immediately. When a decision is made, review it incredibly carefully. And look, if your claim gets denied, do not panic. You have the absolute right to appeal a bad faith denial, but keep in mind you typically only have 180 days to do so. Legal counsel can be incredibly helpful here if you find yourself hitting a wall. To wrap things up, think about this. Nobody wakes up wanting to file a disability claim, but preparation is the ultimate financial defense. Having the right income protection already in place, with definitions and terms you actually understand, gives you incredible peace of mind. It means you can focus entirely on what matters most, your health and your recovery.
So I'm going to leave you with the exact same question we started with. If your income stopped tomorrow, how long would your savings really last? Please don't wait until a disaster strikes to find out the hard way. Take a look at your employee benefits, review your individual policies, and just make sure your safety net doesn't have a giant hole in it. Thanks for learning with me today on The Explainer.